My name is Linda Kreitzman. I'm the Executive Director of the Masters in Financial Engineering program. The MFE program and the International Association of Financial Engineers would like to welcome you to our panel, How I Became a Quant panel, which we hold every year. And we'll have a discussion on careers in quantitative finance. And we have a wonderful panel in here, and they'll introduce themselves when we start. But first, I'd like to introduce you to David Jaffe, the Executive Director of the IAFE, the International Association of Financial Engineers.
Thanks. Excuse me. Thanks for coming out tonight. Some of you have probably seen this panel. This started about 7 years ago in New York, and it's grown into its own little entity. We're doing the How I Became a Quant panels in about 10 different cities a year throughout the country and also in London. And as you can see, they've become quite popular. I just want to do a couple of thank yous. First of all, to Berkley's Global Investors for sponsoring this event, and also to the Haas School and the MFE program for hosting us once again in, I think, our 4th year. The International Association of Financial Engineers is a nonprofit trade group based out of New York that really is about fostering the field of financial engineering, both for those who are interested in joining the field and for those already in the field. Our student membership is $25. We've kept it pretty cheap over the years for students. So I really encourage you to go to the website, iafe.org, take a look at some of the things that we're doing. One of the big member advantages is a lot of our series of events that are in New York and London for practitioners. There's speeches by Jim Simons and a few other folks you'd recognize. There are video recordings such as this one online, and you can watch all of those as a member. So with that, I will turn it over to the to our moderator. I would make note that this event will be recorded. The camera will be on stage the entire time, so your face will not be seen. But if you do come up and ask a question, your voice will be heard and maybe you're back. Okay? Thanks so much.
Are we on? Great, thank you. Thank you all for taking the time to meet with us here today. We're going to start out by introducing ourselves. So this is really meant to be a interactive event. This is a service for you to have a chance to find out more about financial engineering and quantitative finance. Each of us can talk about ourselves at any point in time, but this is a great opportunity to ask questions. What we're going to do is start out by spending a few minutes introducing ourselves, our background, how we got into the field of finance. I'm going to open up with several questions about financial engineering and the markets today. And then we have a microphone that's in the middle of the aisleway. Don't feel shy at any point. Just feel free to get up and stand behind the microphone. If there's someone there already, you can line up behind it, and we can take questions from there. So starting out in terms of background, I have the distinction of being Canadian. So after 7 years here in the States, you'll still hear the occasional accent if I'm talking about instead of about. I also have the distinction of being the least educated of everyone here. I have an undergrad in finance and a master's in financial engineering from Berkeley. I joined a small asset management firm when I graduated from finance at the University of British Columbia. That small asset management firm was promptly acquired by a very large bank called HSBC, which was formerly the Hong Kong Bank. With Hong Kong Bank, we became a Canadian subsidiary and of the asset management firm, and went from having about 45 employees to having about 110,000 employees. I spent about 8 years with HSBC in a variety of roles. I was part of their global strategy group. I spent time in Hong Kong and in London. I was based out of our Vancouver office, and decided in 2001 that it was appropriate to take some time and improve my own intellectual capital, and to do that by getting a financial engineering degree. I had been taking mathematics courses over night school while working full-time, and had a second undergrad coursework completed in mathematics and taken courses in computer science. and felt that the financial engineering program at Berkeley, it was the first year they were launching it, would be an ideal way to combine my interest in finance and the quantitative skills that I was developing. After graduating from Berkeley, I had an option to return to HSBC and run their office in New York, and started to talk to Barclays global investors and have a better understanding of what they were trying to do in the fixed income arena. So I've been with Barclays now for close to 6 years in a variety of research, portfolio management, and trading, as well as business roles. I'm currently responsible for our Japanese, Canadian, and Australian offices, and sit on various investment committees for BGI. So that's my background. With that, I think we'll just go down the moderating table and start with Sydney Zhang. If you can just spend a few minutes and introduce yourself.
Hi, everyone. So, can everyone hear me okay? I got into finance sort of in a roundabout way. So finance is actually the third field that I worked or studied in. I majored in computer science as an undergraduate in China, and came to the U.S. for graduate school right after, and then I switched my major to statistics, and for that, my dissertation had nothing to do with finance. It was on traffic engineering, and then I spent a year in the high-tech industry during the internet boom years. Then somehow I landed a job in a hedge fund in 2001 that got me into finance. I worked there for about 2 years, and then back then I decided to get a broader view of the industry of finance, and also about the field of finance, and I thought the financial engineering program is ideal for me to learn that. So I came back to school into the Berkeley's MFA program, and I graduated in 2004. After that, I joined a firm called Pacific Alternative Asset Management Company, or PAMCO, which is about 10 billion fund of hedge funds right now. So I work on the risk management side in that firm, so looking at different ways to model hedge fund risks and how to control risks in the setting of a multi-strategy fund of hedge funds. And I've been there for about 4 years now.
Lisa?
Thank you. Hi, I'm Lisa Goldberg, and I work for a firm which is right across the street from this campus. It's called MSCI Barra. Can you hear? Is that better? All right. Okay, there we go. I work across the street, that is west of the campus, at a firm called MSCI Barra, which has its roots in UC Berkeley. It was started by Berkeley professors around about 30 years ago. I went into finance in 1993. Prior to that, I was a math professor, and I still am a practicing mathematician. And mathematics, I think, is really the lifeblood of quantitative finance. I hope we get to talk about that. It's really a great background to have if you're going to go into finance. It helps in all kinds of ways that you expect and others that you don't expect. And I've got into the field also by accident and with no real prior training. My first bosses were colleagues now of Jim's, Ron Kahn and Richard Grenold, and really gave me a great start by learning how to think about applied problems and apply quantitative reasoning to them. And it's really been just fantastic how much the things that I learned early on have been useful to me throughout my career. I've worked in fixed income. I do a lot of risk analysis, quantitative risk analysis, and always mixed with fundamental risk analysis, because good quantitative risk management is fundamentally based, always, we've found. I've worked with currency risk, For a very long time, I've done credit. I know many people are interested in working on credit. It's a hot field, and I hope we get to talk about it. And both the valuation and the risk of credit. And then in the past couple of years, I've spent most of my time considering alternative ways to look at risk, tail risk, different kinds of measures, temporal aspects of risk, lots of topics we can talk about. In finance, it's a great opportunity to do a kind of research that is practical and as intellectually stimulating at the same time as anything that I know of. So it's a great field, and I'm glad you've come out to learn more about it.
Excellent. So thank you, Lisa. Andrew Cohen is our next speaker. He's very current in terms of the job market in that he will be graduating tomorrow. He's joining a small boutique that some of you might have heard of by the name of Goldman Sachs, and I was going to give you a bit of introduction into his background.
Thanks, Jim. Well, so like Jim, I have the distinction of being a Canadian, and when I was doing my undergrad, I had no idea that I'd end up in finance. I did my undergrad at McGill University in Montreal in electrical engineering, and I guess at that time I sort of put finance in the wishy-washy field of management and that kind of stuff that sort of didn't belong in the hard field of science like engineering did. And after I finished my undergrad in electrical engineering, I worked at a small firm as a C++ programmer for about a year. I got really interested in artificial intelligence. I went back to do a master's in electrical engineering, concentrating on artificial intelligence. And when I finished that, I sort of, the tech bubble had really popped, and there was a lot of outsourcing to Asia, and I was thinking, maybe this isn't the field I want to be in. And luckily for me, there was this firm called Capital One that was hiring engineers out of university, and I joined them in their Toronto office and had a really, really good experience with that. I learned statistics. This is a company that was hyper analytical, that they analyzed everything, every decision they made, and that sort of gave me an introduction to the basics of discounted cash flow analysis, that kind of stuff. And while I was there, I'm a pretty curious guy. I was sitting right next to our CFO for our office, and I kept on popping over and asking questions. Why is it that we do this? And questions about the stock market and so on. And after a while, he kind of got tired of it and said, you should just do your CFA, and then you won't have to ask me all these questions. So I started doing that, and as soon as I started reading about this stuff, Markowitz, portfolio theory, all this kind of stuff, that really changed my opinion. Whereas I used to think that finance was this wishy-washy field, I really saw that this was a really cool analytical field, and it really appealed to my sort of scientific mentality. So as soon as I started doing that, I realized, I really want to work on Wall Street. And then it was just a question of trying to find the right way into it, and that's how I came to the MFE program. While I was here, I did my internship at Goldman Sachs in the Special Situations Group, which has sort of a funny name. It's a prop trading desk, which means that they take the firm's own money rather than their client's money, and they invest it, usually in pretty illiquid assets, so stuff that they can't flip around the next day, but they have to sit on for maybe a couple of years and manage the risks on it before they can make money on it. That's it.
Great. And then last but definitely not least, on my far right-hand side, we have Matt O'Hara. Matt O'Hara I've worked quite closely with. We were able to attract to BGI just, I guess, about 5 years ago. It works with me in the fixed income area. As you can see, he's usually quite shy and reserved, so this is a big step to get in front and talk to everyone here. Matt also has the distinction of being one of the most sought after How I Became a Quant presenter, so we're very fortunate to have
really
him
second only
here.
to Andrew Lowe
Yes.
in presentations, I was told.
So Matt, brief introduction.
Thanks. So I came to finance a little bit late as well. My road, I guess, is pretty similar to Sydney's in some way. Growing up, I always thought I would be an engineer, specifically a mechanical engineer. I went to Maryland undergrad, then Berkeley for graduate school. Got a PhD in 1997 and specifically worked in the area of computer disk drives. Riveting. Interesting. Actually, the work itself was very interesting. I ended up going to a company called Maxtor down in Silicon Valley. By a show of hands, people have heard of Maxtor? Sweet. This is interactive. Frequently, I get blank stares. They actually don't exist anymore. They were subsumed by Seagate, I believe. Although you can still buy a Maxtor branded drive with my designs in there. Anyway, so I did that for about 3 years. It was actually very directly relevant to the work I had done in graduate school, just sort of continuation. I sort of felt that although the work was interesting, the industry was a bit staid, if you will, and you can only move up through attrition. So I wanted something that was a little bit more dynamic, shall we say. So the next job I took was at a company called Rapt, R-A-P-T, as in to stand at rapt attention. It was kind of a internet-flavored company, if you will, but they did system software. And they actually still exist. You could find a website with their name on it. So basically the idea there was stochastic supply chain optimization, and that's where I was introduced to the idea of financial style algorithms to solve these types of problems. So I'd sort of been on both ends of the spectrum. I felt like I was at a company that was very stable and it was hard to move up, and I was at a company that was, for lack of a better word, not as stable. You can move up very quickly but also be out of a job. So I was looking for something in between. And I came across financial engineering as something that looked interesting, that was intellectually challenging, and relatively dynamic. And so I had a PhD, and I started looking into getting jobs directly. I found that it was somewhat limiting, at least for the people I talked to. And so I decided that getting an MFE was a good idea because it would give me a much better overview of the field of finance. And that's essentially what I found to be the case. In addition, it gave me introductions to people in the area, both at Berkeley and at other places. And in fact, the year we graduated, Myron Scholes was the speaker, and I actually exchanged a couple emails with him. That was sort of the highlight of my finance career, at least to date. Wow. So after finishing at, let me add this. So when I was in graduate school the first time around, I studied essentially numerical solutions to partial differential equations, which means a lot to some of you, I'm sure. And so I thought that I would become what you might call a desk quant, that is solving or figuring out how to solve the value of complicated options. So a very sell-side feeling exercise, that is, how do we hedge out the risks that we bear in this option? So my internship was at Lehman Brothers in Tokyo on the fixed income derivatives desk. And that was actually sort of a perfect fit for my background. What they were trying to do was solve a complicated option using finite difference versus a Monte Carlo simulation. So in the course of 2 months or so, I wrote an algorithm to do that. And they found out that some of the characteristics, if you will, of that option were not what they expected. So that was a good discovery for them and for me. That ended up actually being the subject of my paper that went fairly well. And then after I left, I thought I would go back to Lehman, but I kind of had a predisposition to be on the West Coast, so I looked into going to BGI, which was one of the more respected money managers. And I actually hate to admit this, but I didn't know they did fixed income before I was interviewed there. So Jim actually taught me that they do have fixed income, and more importantly, have active fixed income. So on the buy side, basically what we're trying to do, more or less, is forecast asset returns. That's kind of the basic premise, but in a risk-controlled manner, using the risk characteristics coming from models of places like Barra. So I started out in fixed income, active fixed income at BGI. Initially worked in the credit area, later worked in rates, and I'm now in a very hot area, if you consider toxic zones hot. Subprime mortgages is my main modeling exercise these days. And I'm happy to answer questions on any of those subjects.
Great. Well, I'm sure you have, I'll have a lot of questions. How do you get a job? How much will you get paid? Can I have a job? What does the current market mean about getting jobs? Do you need a PhD, an MBA, an MFE, a CFA? What do all these initials mean? But I think we'll feel free, if you do have any of those questions, to just get up and move to the mic, as mentioned, right in the center. But I think we'll kick it off just with a few general questions. So what exactly does financial engineering mean? How do quantitative methods get applied in finance? And for that, why don't we turn to Matt O'Hara?
So engineering means to me the application of what I would consider to be scientific processes to the investment process. Meaning, historically, people would pick stocks and buy them, or pick stocks and short them, without any real sense of what the risks they were bearing were. So, Richard Grenold and Ron Kahn and Barra, to a large extent, came along and quantified those risks. I think that was sort of the first step in the active portfolio management process. And on the buy side, it's what BGI subscribes to and has served us fairly well. And then on the sell side, if I may be so bold, I would say that it's primarily about modeling asset processes and figuring out how to hedge those risks appropriately. So that's kind of my understanding of the two different pieces, of the main pieces of financial engineering.
Okay. Next question is for Lisa. When you're looking to add to the team, or when you're looking at bringing on people to Barra, how do you consider people's educational background? Do you look at someone with a PhD different from, say, a master's in science, different from, say, an MFE? And how does that prior educational experience dictate the types of roles that you would consider them for?
Well, that's a really great question, Jim. Thank you. To the extent that we can, we try to take account of a person's skills, abilities, interests, and the way a person presents his or herself, more than any particular set of letters after the name. I mean, that's always the goal, right? And in any of those categories, I've seen a lot of different kinds of people: great PhDs, bad PhDs, great PhDs from Berkeley, bad PhDs from Berkeley. However specific you want to get, you get a range. So there really is a value, a lot of value to looking at individuals, but of course, given our time constraints and given the high volume of traffic in our industry, how you get classified often does dictate what stack of resumes yours will go in. So I think that whether we like it or not, we do rely on heuristics. So very strong quantitative engineering PhDs get sent to exotic derivatives jobs as a first cut. They can be rerouted. People with MBAs end up trading or product development or selling one thing or another. People with computer science degrees end up as a first cut in software engineering. And of course, the MFEs, Berkeley MFE program, has such a wide range of people in it that when we get one of those, we always like to get MFE resumes, and we do then look and see. Very often the person has a PhD in something else, which dictates the stack, but that really covers a huge gamut. So, we use them as heuristics. We try not to rely on them, but it would be impossible for me to say that you don't need a degree to get attention in a very busy world.
Right.
Can I add something to that?
Yeah, please, Andrew.
Yeah. So, like Matthew, I think before I went into the MFE, I tried my hand at getting a job on Wall Street. At the time, I had a master's in electrical engineering, and I was a statistician at a consumer financial firm, Capital One, like I said before. And I had a heck of a time trying to get people to listen to me. I went through some headhunters and basically had no luck at all. When I was interviewing for my internship here through the MFE, I had a few courses under my belt, and I learned a lot from this course. But to the first order, the difference was, and I had huge amounts of interviews with people, and I had several offers, and it was just a huge difference. I mean, so I guess my point here is not particularly on kind of graduate degrees versus not having graduate degrees. It's getting in touch with the right people. And if I can put in a plug here for the MFE program, we just have really good success with the recruiting pipeline, and it just makes a huge difference in my experience.
Great. I think you get your payment for that endorsement.
Your envelope will be waiting outside.
One check mark. Very good.
Can I add one thing to that as well, Jim?
Oh, yeah, absolutely.
Briefly?
Yeah,
Okay.
please, Matt.
I think that there are a lot of people with PhDs who kind of toy with the idea of going into finance. Like, it seems like an interesting area. It may be something that I'd like to do. I'm not sure. And I think that getting a degree in finance or studying for the CFA or something like that shows a dedication to switching careers, whereas just sending a resume in on a lark doesn't quite show the same level of commitment. I would say that's one thing that I notice when I talk to people.
Yeah, I think that's a great point. In terms of the MFE, it really is less of a standalone and much more what is that MFE graduate coming with prior to completing the program. So a PhD MFE looks different to a prospective employer than a undergrad MFE. So I think that prior background is pretty critical in terms of the roles that are available. The next question's for Sydney, and when most people think of hedge funds, they think of George Soros, or they think of people like Andrew Cohen going out and doing proprietary trading and mixing it up. What exact roles are there for quantitative techniques in hedge funds? And you can answer either in terms of fund of funds, but also in terms of the hedge funds that you analyze. Where do you see quantitative techniques used in what's really considered by most to be a trading activity?
Well, hedge funds really cover a huge varieties of them. There are some are very quantitative driven, but the bad news actually the vast majority of hedge funds are probably less quantitative driven. So the biggest amount of hedge funds out there, so maybe 30-40% of them call themselves the long short equity hedge funds. So those are essentially stock pickers. They go around looking at the financial statements of companies and do channel checks, etc. But those are mostly fundamental research on different companies. For those positions, people with prior industry experiences and maybe say an MBA experience probably are more suitable for doing that sort of work. In terms of the more quantitative hedge funds, the biggest category is probably equity market neutral, where so BGI has some hedge fund business which are definitely more quant driven, and in order to do that you need the proper quants to do it, and convertible arbitrage is another strategy that needs a fair amount of quant skill. But by and large, so the hedge fund industry also, you have the big hedge funds like Citadel, where it's a very institutional environment, and then you have the right infrastructure for quants to do work, and then you also have a lot of 2 to 3 people quant shop. So I don't think you can really say in general terms like what the hedge fund industry can offer you. It's very much a case-by-case situation. So in terms of funds industry, so traditionally and even now, so fund of funds tend to be more of a not very quantitative driven industry. So PAMCO is probably the exception here, in the sense that we have better data in the sense we get position level transparency from the underlying hedge funds that we invest in. So in order to understand their risks, then we do need to model the exotic derivatives that the hedge funds trading, and also to be able to roll it up and at the strategy level all the way up to the firm level. And we also look at innovative ways of modeling the data to understand the trading behaviors of the hedge fund, and then so that we can use that information to as an early warning system so that we can leave a manager before things really start to unravel. So that's really what attracted me to to this particular firm. But in terms of the industry in general, a few bigger shops would have more quantitative-oriented roles. But in general, so the people they need probably would be more suitable for MBAs and maybe someone with the technical master, usually not at the PhD level, I would say.
Got it. So before we move on, is everyone familiar with what a hedge fund is? What a fund of hedge fund is? Is there any? And you raise your hand if you aren't. Okay, well, we got at least one. I think, well, let's start with that. There's a few. Everyone's just a lot shyer. So, Matt O'Hara, quick explanation. What is a hedge fund, and what's a fund of hedge
I'd
fund?
like to start with buy side versus sell side, because I didn't know
we can
what
start
that was
there.
before I got into finance.
Yeah.
So, buy side firms, or hedge funds are buy side firms. BGI is a buy side firm. It's a firm basically that invests client money for the purposes of getting some return. Sell side firms are firms like Goldman Sachs, Morgan Stanley, JP Morgan, Lehman Brothers, Bear Stearns. These are firms that bring securities to the market. So if a company needs to issue debt to raise capital, one of these companies will underwrite that, or they will bring it to the market. So they're selling the securities. We, on the other side of the transaction, would decide if we think it's a good purchase or not. So we're buy side in that regard. There's a whole range of buy side firms. BGI started out as an indexing firm. That is to say, we just tried to mimic the returns of indexes like the S&P 500. And I guess the first several $100 billion that we took in were in indexing money. And then you start moving into what we call active space. That is, you're trying to beat an index, or you're trying to beat LIBOR return or some treasury return. And so hedge funds are sort of at typically the farthest end of that spectrum, i.e., they're taking the most risk and they're trying to get the highest returns. BGI is probably, for most of its product, closer to indexing. That is to say, we take on the order of 1 to 2% risk, meaning that we're expecting 1 to 2% return above an index. A very active fund would be on the order of 7 to 8% above an index, and hedge funds, in some cases, can be as much as 20 up to 100% return in a given year. So that's kind of the ecosystem, as I see it.
Excellent. Next question's for Andrew. As a recent graduate, you're probably the most intimately familiar with the job market. We've seen a lot of volatility in both stock markets and in the area that Matt O'Hara focuses on, structuring subprime securities. Not to say that he was at all responsible for any of the volatility that we've seen, but
not enabled this at all.
No, purely, yeah. Anyway, how do you think that this most recent market volatility has changed the job prospects for quantitative individuals within finance? Do you think it's harder to get a job now than it would have been, say, a year ago or 6 months ago?
Yeah, well, just to start, so I think that quants can't escape some of the blame for the subprime mess.
Easy.
That's first.
And not all of it, of course, but some of it, some component of it. And if there is some blame there, it's not so much that the models are wrong, but that you sort of, there's always some things that fall in between the cracks. Like you make some assumptions, and then you make a model that's based on those assumptions, and you always have to dig a little bit deeper and make sure that those assumptions are always holding, that they're not going to change. So yeah, there's maybe a little bit of blame there, and for sure in revenge. Quants have been punished in terms of the job market. So yeah, for sure, it's harder this year than it was previous years. Not to say that there aren't still jobs, there are, and Linda works very hard to find them. But yeah, it's going to be a tough 6 months to a year, I think, and I think hopefully it'll recover.
All right. Well, I can continue asking questions all evening, but the goal is also to get questions from all of you. So as an incentive, I have 3 business cards here, which are Matt O'Hara rookie cards. They're incredibly valuable. For the first 3 people who have questions, you get a Matt O'Hara rookie card, and you have the opportunity to email him any career questions. So we've got 1 taker, 2 takers.
I promise to reply. I promise to reply.
We've
That's
got
part
3
of the deal.
takers. Excellent. Okay, starting off for questions in the audience.
Oh, yeah, I've actually been dying to ask this question because I was actually in the same situation Andrew was a while ago, where I'm looking for a job. I graduated with a degree in finance, and recently, because of the job market and also because of my interest in quantitative finance, I've been looking more at designations, like the CFA, so I'm a level 2, and also I was wondering if any of you have heard of the FRM and what your take was on that. It's hosted by the GARP, Global Association of Risk Professionals.
Yeah. I have heard of that.
Yeah, I think that's probably
And
a good Lisa
also,
question.
if the CFA was seen as the equivalent of a graduate degree in finance, because I don't really have an interest in going for an MBA because it'd be like getting the same degree all over again. So.
Okay, so it sounded like there's two questions. Number one, do we have any information on the FRM designation and how that gets viewed in the industry? And second question was related to the CFA, and would that be considered on par with a graduate degree in business, such as an MBA? Is that right?
Correct.
Okay, excellent. So let's start off with the first question. I guess either Lisa or Sydney can answer. Why don't, Lisa, you take a stab at it first?
I think I'd do better at the second question first. I'm not that familiar with FRM. I've heard the term, and I don't really understand the distinction between
Sydney?
the CFA.
Yeah, FRM, I believe it's Financial Risk Manager designation. It's the organization behind it. I believe it's GARP, right?
Mm-hmm.
It's
Correct.
in the along the financial designations, specifically in terms of financial risk management. FRM is probably the oldest and the widest recognized. So, and I've looked at the curriculum of the FRM requirement. It's definitely a very well-constructed curriculum. I think for me, so going out to get a designation in the finance field, be it FRM or CFA, etc., I think it's probably more important for someone without any formal education in finance or formal work experience in that field. It definitely shows the serious interest in that field and shows the skill level and the commitment, and those are definitely plus factors when I look at the resume.
Excellent. So then in terms of the CFA program, Lisa?
Well, there seems, I mean, in my mind, they're really complementary. Again, I'm not that familiar with FRM. The CFA is a great thing, but it seems more of a practitioner type of degree. And what you get at a university, I would say, is more theoretically based. And I think one doesn't supplant the other at all, and that they're both very valuable and in different ways. And the combination is terrific.
Yeah, so I think both Andrew and I are CFAs. Do you want to say why you took the CFA program?
Yeah, sure. So if I think if the question was, well, is a CFA comparable to, say, an MBA? I think maybe it'd be comparable to some MBAs. It's probably not comparable to the MBAs that you want. I think that's the issue. The CFA is great in terms of curriculum. It's a very well-designed program. I learned a lot from it. It's very cheap compared to getting a degree. It's a few $1,000s. It's a lot of work, but it's definitely doable. I really recommend it if you want a great introduction. If you're here and you don't know much about finance, maybe you're a physics grad or something like that, or doing your PhD, and you're thinking, okay, doing it and say an MFE degree might be a pretty big commitment. I want to know if I'm going to enjoy this before I go into it. Well, the CFA level 1 is a great way to start. It won't cost you that much. You can study on your own, and you'll read the material, you get a good introduction, you'll know if this kind of thing is for you. A good part of what you get from a graduate degree, I already mentioned the MFE. You're sort of getting that kind of recruiting pipeline aspect, and I don't know that if you just add that CFA to your resume, that'll be enough to get you the job that you want.
Yeah, I think that's a great point. And also, in terms of the CFA designation, you do need 3 years of work experience in the field of financial analysis. So I think CFA Level 1 is a great way of getting a better understanding of the field and determining whether it's something that you would enjoy doing. But to get a full designation is really meant for practitioners as a means of honing their skills. So we have our second winner of the Matt O'Hara rookie card. What was your question?
Hi, my name is Quant, and I'm from the MFE 09 class. My question is about compensation. From what I heard, most quants start working in the back office making probably 150K to 300K a year as a quant. On the other hand, I've heard people who make it to the managing director level, they're making several $1 million a year. That's what I heard. So my question is, how do I go from point A to point B?
Points for honesty.
Exactly. So just to be clear, you wanted the 150 or the 5 to 7 million? Okay. Well, I guess as someone who's rapidly on his path between those two numbers, Matt O'Hara, did you want to? I won't say what spectrum he is in terms of those numbers, but exactly how does compensation work in the field of finance?
Point B again?
How does compensation work? What could a
question.
quant expect coming into it, and then how do you progress in terms of career and in terms of compensation?
In American society, it's always a little bit uncomfortable to talk about direct numbers, but I'll try to talk in general in a way that's still useful. How's that? So I think that the numbers that were thrown out for point A are probably in the ballpark. I would say, 300,000 for a back office quant coming out of school seems a bit high, but I don't work at a sell side bank, so I don't know. But it's in the ballpark. I would say that I wouldn't get too hung up on the numbers though, because it seems that in finance you can certainly make a decent living, and there are people who make $5 to $7 million, but there aren't a lot of them, and it's a precarious path to get to that point. So the point is, if you're in it just because you want to make that $5 to $7 million, it's going to be tough to get that far. I.e., there's a lot of work between A and B to get to that point. For example, if you want to make it to a proprietary trading desk at a sell-side bank, like somebody on this panel, for example, it's typically a very long path. That is to say, you start out as a trading assistant, you become a trader, you have to demonstrate quite a bit of expertise in that area, you have to be able to, quote-unquote, beat the market, and then you're rewarded with a proprietary trading job. And then if you're good at that, you can move up and maybe even run that desk. That person's making $5 to $7 million. It's not easy to get to that point, is what I'm trying to say. So there's certainly a skewed outcome or a skewed distribution of incomes in finance, but just like a skewed distribution, there's a very small tail, and the probability is relatively low of getting there. So I don't want to discourage you. It's certainly a very good outcome, and it can be achieved, but it takes a lot of intelligence, it takes a lot of commitment, and it takes a lot of hours to get to that point. So just be aware of the commitment necessary. It's not like you put in your 8 hours a day for 10 years and you're at $5 to $7 million. I just want you to be clear about that.
Lisa, did you want to add something to that?
Yeah, it also takes a lot more than quantitative analysis. You have to get really interested in markets, in traders, in behavior, in information. Quantitative stuff is a tool. You can stay in a sell-side job valuing exotic securities. It's a fascinating thing to do, and never really see the front office for a very long time, and lots of very quantitative people like that. So you really need, I would say, a broad set of interests in addition to great quant skills to have a hope of getting to, I forget if it was A or B at the end.
Yeah, and I think a touch of luck as well. I mean,
a lot of them. we all.
You can look at the people in the securitized products industry, such as myself. And what you saw is that there was actually a huge growth in those types of jobs over the past 4 years on Wall Street. And in fact, our parent company, Berkeley's Capital, a lot of its growth was driven by securitized products. We do primarily fixed income. So for those people, they can be very bright, very hardworking, understand markets, understand people, be very good traders, and the market itself could go away. So you bear that risk as well. So it's just something to be aware of also. Yeah, and just, in closing, in terms of compensation, it tends to be very closely linked to the revenue that you're bringing into the firm. So if you're going to get paid that type of numbers, and your department that's working for you are going to get paid that type of numbers, they have to be making somewhere between 5 and 10x that number for the firm. So if you're considering it to be a 5 to 7 million person, you have to be adding $50 to $70 million to the firm, which means you have to be doing a lot to generate that type of revenue for the firm.
So last of the Matt O'Hara rookie cards, but probably only the third of very many questions, please.
So my question is specifically focused on the MFE program. I'm trying to compare the programs with other universities. So what I'm interested in is in risk management and use of technology in the financial services industry. So can you talk about how the MFE program prepares someone to actually take a focused risk management career, or something that's totally focused on doing computational finance, like something on the lines of Renaissance technologies, right?
Right.
So, I mean, does the course prepare you or prime you up for that, or can someone talk about it in terms of risk management and use of technology?
So just to be clear, the question was, how does the MFE program prepare you for a career within risk management in the financial services sector? Yeah. And is the course content help establish you for that type of role? Is that broadly right?
Actually, it's slightly more refined than that. I know some of you spoke, I think Matt and Andrew spoke about the subprime meltdown, SIVs and all that. So essentially what I want to understand is how does the course mold, or the applicability of the course in situations such as that?
Okay, so how applicable is the course content you would learn in a program like the MFE for extreme events like we've been experiencing over the last 6 months?
Exactly.
Well, maybe Lisa, do you want to start with how quantitative risk management techniques, the challenges that you see in illiquid and markets like we've seen most recently?
But you want to talk about extreme risk. Well, yeah. I think that's probably just seeping into MFE type programs. Please correct me if I'm wrong. I assume that most of the courses that I know about in MFE programs think of treat risk as standard deviation, and that is well known not to be exactly the right way to navigate through markets like the ones we have. Now, generally speaking, there's a huge array of courses that teach you how to handle risk. One very interesting one, for example, at the Kellogg Business School in Northwestern, taught by my colleague, Bob Koralczyk. That course is where the students get several $1 million and actually manage it. That's the course. Yep. So I think that's kind of a good way to manage either extreme risk or volatility or any other kind of risk. But so I would not expect to see classes too much in extreme risk at this point, because I think the industry is in its infancy of figuring out how to deal with that. So you may be able to get intern projects in that or do some research on your own, but I don't think you're going to find much by way of structured courses. Certainly if you take Ron Kahn's asset management course here, or from Hayne Leland, or from many of the wonderful Haas Business School professors who have managed money themselves, you're going to get a very good picture of the top-notch industry standard methods as they've been, as they've evolved since the 1950s when Markowitz told us how to do it.
Yeah. Did you want to add something, Andrew?
Yeah, we do. So by and large, you're right, Lisa. The classical view in finance is sort of these log normal distributions that are very well behaved. We do have a course taught by Philip Jorian on value at risk, which does talk about sort of these extreme tails and how to characterize them. But so yeah, we spend time wringing our hands about it. I don't know. No, it's a good course. I don't mean to put it down. I'm just saying that the nice thing with the kind of classical view of finance is that it's very, you can manage it. It's very well behaved. You can do something with it. And then if any of you have read anything by Nassim Taleb, I believe his name is, The Black Swan. If you sort of believe, and to all evidence this is the truth, that every now and then you get these extreme events that are inherently unpredictable, I don't know to what extent how much you can do about that, other than not leveraging yourself up too much.
Well, I can respond to that, or maybe Sydney can. There's a beautiful area of statistics called extreme value statistics that does not. It's not a crystal ball any more than any other kind of statistics is. It doesn't tell you when the next big blast is going to happen, but it does let you look at these problems quantitatively. And I think this theory is coming into finance very heavily. And one point which I always like to make whenever I get the chance about value at risk, I don't know what's in Jorian's course, but value at risk, I think, is often taken to be an extreme risk measure. This is a misconception. For example, if you're at VAR 99, you're looking at the best thing that could possibly happen to you on that one bad day out of 100. The real extreme risk question is, what the heck does happen to you on that one bad day? And this theory, extreme value statistics, which maybe is addressed in this course, but again, it's coming up, does give you a way maybe not to get super accurate measurements around that, per Mr. Talib, but does let you think about it in a quantitative way that I know that we find very useful at Barra.
Sydney, did you want to add something?
Yeah, sure. One thing, extreme value theory is finding more and more applications in the field of quantitative management, and also to add to what Andrew's comments, not having a whole lot of leverage is a pretty good rule of thumb as risk management, especially when you're dealing with very liquid investments. And probably this is not directly related to the question on the applicability of the MFE curriculum, not specifically of risk management of extreme events. I think what you learn in the MFE program is very applicable. And Andrew and the other ex-ME students can probably also add to that. But when in internships and then in your first job, you do find that what you learned in the school are very much, you could say, on the cutting edge of things. And you came to internship and you bring new knowledge to your group, etc. The learning curve is pretty high, and you certainly learn very useful things through the class.
And Matt, just a real quick question. You've been working in a misbehaving market. How have you found quantitative techniques helpful in such challenging markets as we've seen over the last 6 months?
Well, I'd echo Lisa's sentiments, which is, it's relatively new to kind of come up with an extreme value measure of what your risk is in a portfolio. I mean, maybe this is a terrible admission, but we at BGI love, mean variance optimization, right? And that's pretty well understood. It's a question of calibrating, what your variance is. There's some ways of accounting for wider distributions than you've actually seen historically. But quite frankly, to see what we've seen in subprime mortgages or in securitized products, it just takes agility and nimbleness and sort of figuring out things on the fly as you go and hopefully containing the damage, quite frankly. Because it's not something that you can plan for, because if you did, you probably would never invest in this asset class.
Right.
One type of risk, which is also, I think, very cutting edge area for people who might want to go into finance that you must be dealing with a lot, is liquidity. And there are, once again, like most kinds of financial risk, it's a mix of a fundamental perspective and I think some really exciting quantitative and statistical techniques that I see coming up in the literature now.
But it seems that every new crisis reveals a new risk that we hadn't accounted for previously. And for those of you who are interested, you can look into the area of hedge fund replication and the idea of alternative betas. So alternative betas are other exposures that you bear as opposed to just sort of industry or the standard exposures you might think of, like size or the Fama-French factors, for example. And liquidity is one of those betas, if you will. And it's something that I don't think was properly accounted for previously, but is under quite a bit of investigation right now.
As are another kind of alternative betas, shortfall betas. You can have betas against extreme risk measures just as you have betas against volatility, and they are turning out to be quite useful in this application as well. So it's in a different dimension of alternativeness, I think.
Yeah.
Another question from the floor.
Hi. So we heard about the tough job market and the subprime crisis affecting potential job seekers.
Could we get you to come just a little closer to the mic?
Okay.
Great, thanks.
We heard about the tough job market and how the subprime crisis is affecting potential job seekers. My question is about finding jobs in other big financial centers like London, for example.
Mm-hmm.
Would I be able to interview with a company here and specify that I'm more interested in an overseas post? Would that be an option? And how does that work typically?
Sure. Well, I'll turn it to some of the panel shortly. I think to start out with, I think it's important to keep in mind that this is a crude approximation, but probably 80% of the jobs in finance would be on the East Coast rather than the West Coast. So there is a very large set in between, if you think all the way from Boston, Connecticut to New York, which is where the bulk of the jobs, especially on the sell side, pretty much all the jobs are going to be. If you look outside New York, there's at least as large a market, maybe slightly smaller, but very large market in London as well. I think over the last 2 or 3 years, there's actually been better growth, job growth out of London than New York, primarily because of regulations such as Sarbanes-Oxley, some of the challenges related to getting into and out of the U.S. post-September 11th, and you've seen a lot of banks expand their work overseas in areas like London. Maybe Matt, this would be a good question for you. Do you have a sense, if you were looking for a role in London, how effective it would be to interview here for that type of role?
If I could actually slightly alter that question, 'cause I worked in Tokyo for my internship, so I'll try to speak to that. That might be a little more relevant, but hopefully transferable.
You mentioned Lehman Brothers, so you were still in the U.S. company, but overseas.
That's correct. And so this information might be a bit dated, and I'm sure the market has evolved somewhat. But my sense was that in places like Tokyo, they were actually very interested in having people come from the United States with finance experience and expertise. I think that, at least at that time, there wasn't a large stable of people locally that they could draw from that could communicate within the firm effectively and solve the problems that needed solved. So whenever I talked to people who were interested in getting into finance who said they had interest in Tokyo, for example, I was like, absolutely, you should certainly look into it. So that's my sense, at least for Tokyo, which I guess on percentage basis is probably about a quarter the size of New York in terms of opportunities. And I would deflect the London question to somebody who's better prepared to answer.
Andrew, do you want to take a stab at what, in terms of the job market, interviewing, like let's say you wanted to work at Goldman Sachs London, how effective would it be to interview here for that type of role?
Well, I have pretty limited experience on that, but I can say that in the group that I interviewed for, the group actually spans Hong Kong, Tokyo, New York, and London, and in fact, there was just as good a chance as not that I would have ended up in London. But I think that's a pretty particular example. I don't really have much experience outside of that.
Okay, go for it. Seems to be there's some. Okay.
Follow-up question from Linda Kreitzman.
Three in London.
Actually, we had 3 brands, SMS, and then
Vision.
and yes, Vision. So 2 of them actually will go for full time. There's a candidate just a couple of days ago who has received an offer from Bears Hong Kong without interviewing on site. We have video conferencing capabilities, actually state-of-the-art video conferencing capabilities at Berkley. Market actually has been very good in Asia. We talked about the economic situation. Well, it is true that there were fewer positions. I said to somebody last year, my job was to go and contact the firms because they couldn't get some of the folks that they wanted to get. And there were students with anywhere between 1 to 4, 5 or 6 offers per candidate. So there are fewer jobs, but no matter what, even in a tight economy, firms are always looking for talent, fresh talent. So, the There have been some candidates who have declined offers, and to date we have approximately 15 jobs that can be filled. Next week, everything will depend on how well the students will be doing their interviews, and second, whether or not they will interview. And if not everybody, I made a commitment to the candidates that within 3 months of graduation, every single person will be filled.
Thank you, Linda.
Thank you.
Very good answer. Another question from the floor.
To a different question.
Right.
Hi there. Oh boy, losing it here. I think that for those of us folks who are switching from other technical fields into finance, the understanding of what real career opportunities there are out there and kind of career paths is a little ambiguous. There's plenty of positions or activities you guys talked about today that I certainly was not aware of before. And I was wondering if you could tell us your opinions on how narrow you think going into financial engineering is in the perspective of the entire finance industry. And also, is there a ceiling that you kind of reach that you can't really surpass based on the degree you have as a quant?
Great. And so how broad is financial engineering type jobs within the finance industry? And then does coming into the industry with more of a quantitative background provide a ceiling in terms of your career within finance? Do you want to take a stab at that first, Sydney, and then we can go down the line?
Yeah, sure. So my perspective is probably different. I work for much smaller companies than Goldman Sachs or BGI, etc. I think if you want to stay doing 100% technical work, you can probably say that there is a ceiling there. So, but to say if you want to expand your role, that often means that to just go out of a pure technical role into taking leads in terms of product development or in terms of a more business-oriented role. And if you are willing to do that, then I don't see any reason that why your quantitative expertise or background should hamper you in your career development. I would say it's probably more of an advantage that you have some hardcore skills comparing to the people you compete with.
Yeah, I think it's a great point that ceilings are rarely because of technical skills or because of technical backgrounds. It's much more your ability to be agile and the skills required, and there tends to be more of people skills required as you move up, whether it's working with clients, working with other individuals and getting new products launched, or if it's working in terms of managing individuals on your team, that always tends to come into the forefront. Maybe Andrew, do you want to give a sense in terms of if you had to look at a firm like Goldman Sachs, what percentage of the jobs would be more quantitative focused relative to a more broad-based finance experience? Do you think it would be 80-20 or 2/3, 1/3, or what does it look like?
So I'm not sure exactly what that split would be, but I think there's 2 points that I want to make. One is that, broadly speaking, the kind of the market penetration for quants has been increasing just steadily for a long time.
Answer.
Sorry. So whatever limits people may have had, let's say 10 years ago, that limit has been pushed back just because there's more quants. So you typically have other quants managing quants and so on. But so the second point I'd like to make from my experience at Capital One, I was a statistician there, and I heard a lot from the other statisticians. It was a common complaint that the statisticians were maybe didn't get the glory. They kind of did the hard work and made some fancy models that would add value, but these other guys in the firm might have gotten the guys that could speak better and that could communicate better would get kind of the promotion. And I think that's broadly the case in at least somewhat in probably a lot of areas. I think people have to really keep in mind that if you want to do well past a certain point, you need to be able to, like others have said, you need to be able to marry your quantitative skills with something else. Maybe it's managing people, maybe it's I don't know, some other thing. And whenever you can marry 2 skills or 3 skills together, you're more powerful, you're more useful than what you would be otherwise. So you really have to be able to stretch out of your comfort zone and add something more.
Matt, you're blessed with both technical skills as well as people skills. It's one of the truly unique attributes. How do you put the relative importance of those two things?
I think this is a great question and one that comes up fairly frequently. I think that Andrew's point is well taken, and that is, it's not just a problem in finance, it's a problem. It's an issue, is that appropriate? For many different areas, many different fields. So the idea is that as a quantitative analyst, how far could you get in finance, say, relative to another field, right? So if you worked at a national laboratory and you were a physicist, how far could you go, right? Would you only be doing experiments for the rest of your career? Is that what you want to do? I would say as a quantitative analyst in finance, you can actually go fairly far, even if that's all you ever wanted to do. I think Lisa made the point earlier, if you wanted to value, exotic derivatives, you could probably do that for your whole career if you wanted. But you would never be the CEO of Goldman Sachs. So I think that you sort of have to look at it on a relative basis. Given you have a quantitative background, how far can you go in this industry versus another industry? And I think fairly far. But then to Andrew's point and Sydney's point, really to go far in a firm, it has to do with what range of skills you have, right? I mean, at Wall Street firms, for example, they sort of take turns. Investment bankers sometimes run the firm, traders sometimes run the firm, M&A guys. It just depends on the individual people. It depends on what their abilities are and their drive to go forward. So I don't think that a quantitative degree limits you. It sort of plants you in a certain area, but then how far you sort of grow from there depends very much on your motivation and skill, if that makes sense.
Yeah, absolutely. All right. So we have about 10 minutes left. I see there's 2 queued up. If there's anyone who's dying for a question, make sure you get in the lineup. Your question, please.
In your current and past positions, can you tell us as a quant whether or not you still have work-life balance? How many hours you might sleep right now, or?
So let's go down the line, and maybe starting with Matt and then heading to the left. Matt O'Hara, how many hours a week do you work?
I probably work about 50 to 60 hours a week, depending on the project. The very first project that I worked on when I got to BGI was the credit long-short hedge fund, and I actually worked very closely with Jim. That's where we formed our very tight bond. And at that time, I probably worked between 12 and 14 hours a day. I think the standard schedule was get there at 7, work till midnight, repeat.
That's some good times then.
Lather,
wasn't
rinse,
it?
and repeat. But it was sort of very project-based, right? So at that time, we had a very strong need to get this product done. It was behind schedule already, and so we were all working furiously to finish it. And once it was launched and we sort of stabilized it and it was up and running and doing fairly well, that dialed back. That being said, finance is driven very much by innovation, and people who can create more work more efficiently are valued above others, and in ways that matters more in finance than others because it's directly tied to money that the firm can make. So, you can certainly find jobs in finance where you have a very good work-life balance, and you'd probably be, remunerated commensurately for that. But to answer the question, I think it was asked earlier, how do you get to $5 to $7 million? It's not by working 40 hours a week. So, you have to work quite a bit. You have to be very productive during that time, and the result has to be usable. So I think that there's a spectrum in finance. It tends to be more on the more work, less life side of the scale, quite frankly, than other industries. And I think it selects people for that over time.
Andrew, how many hours a week do you think you're going to be expected to work when you join?
I think I was probably pretty fortunate in the group that I joined. In my internship, I worked about 55 hours a week. That was pretty typical of that group. People typically didn't go in on weekends. Like everyone else, I heard kind of the nightmare stories before I joined, and to be honest, I probably would have been willing to do that for at least a couple years. But I think speaking to my classmates, some people did have those nightmare hours. Not, not the majority, but there were some. So it's something to keep in mind. There's definitely places where it's expected. There's places where it's not required, but some people do it anyway to show their motivation. And there's places where I don't think it's needed.
So Lisa, I think bar is a pretty good place for work-life balance. What would you consider typical hours in your firm?
I find that a very hard question to answer because for me, work-life balance is reflective of the fact that work life and work aren't really separated in that way. I work a lot, and it's part of my life, and I really love what I do, and I don't know how to count the hours because I'm in the gym, and it's contemplative time, and for me that's a very important part of work, so I wouldn't really know how to count those hours. Some of my favorite ideas have come in the swimming pool. I work a lot of weekends, and there are afternoons when, to be perfectly honest, I'm at my kid's soccer game, and I've never thought of the separation. I find a lot of the problems that we have to solve utterly fascinating, and they take over sometime for long periods of time, and there are other times when I don't get a grip on them. So it's not such a... I really can't give you a concrete answer. I think if you are very interested in what you're doing and like to add value and be useful and solve problems, you won't have an issue with this in any job. I know people in every industry. I know a lot of people at the edge of what they can do, working every hour they're awake, who are not doing anything very productive. I know people who are, writing 4 hours in the morning and winning the Nobel Prize in Literature. So I think it's a really very individual thing. I would encourage you, instead of to ask that question, to find something that you really love to do, and to do that thing. And I think you will find the natural balance. It just comes by itself.
Sydney, how many hours your firm?
I would say probably in the range of 50 to 60. Also vary by time month, because we tend to be busier around the end of the month, just due to the nature of the business. But just a general impression, I think West Coast firms or buy-side firms tend to be better than South-side or Wall Street firms. So I worked more hours as an intern on Wall Street than I do right now, even though I have a whole lot more responsibilities. So I think the peer pressure in Wall Street firms, so everybody does 12 hours at least per day. So, and even as an intern, you sort of get into that mode. There's a lot less of showing FaceTime, that kind of thing, in my current environment, where from what I heard in other buy-side firms. So, which I think it's nicer.
Yeah. I can't lie because my wife's in the audience in the back row, so if I were to tell you something that wasn't true, she would call me out. I guess it's probably about 50, 60 hours a week, something like that. But I think it's definitely a challenge having time for everything you want to do in life. One of the challenges, depending on your role, is there can be travel involved. So I spend time in Australia and Tokyo and London, and clearly that creates a separation. So depending on your role, that can be relatively challenging. But I think the most important thing is really what Lisa said, is as long as you enjoy what you're doing, then you're going to be able to find the balance. It's when you're unhappy with how your current role is, or where you are in your career, or the types of problems that you're working on, or the people that you're working with, that's when that balance gets out of whack. And I think this is probably our last question for the evening, so I bet you it's going to be a good one.
Well, maybe. I'm just a curious outsider, so it might be very naive, but what I'm seeing, by and large, looking at finance as an alternative to academia, is that it's a fairly mature field. You have MFE programs and all sorts of certifications. So what I'm curious about is, where's the action at? What's really poorly understood? You've listed illiquid asset pricing and extreme tail problems. Anything else you'd care to add to that list? Where's the fun at?
Great. So the question is that from your perspective, finance appears to be quite a mature field, that Markowitz and some of the seminal work was in the 50s and 60s, and where is really the cutting edge in terms of the types of problems that are interesting to work on. Is that right? Okay, so why don't we just go down? Do you want to say, Sydney, in terms of your field, what are some of the more cutting edge areas that people are working on in the field of hedge fund risk management?
Well, I think we are probably more interested in using existing techniques in innovative ways than really beyond the cutting edge in terms of modeling, etc. I kind of always look myself more like an engineer than like rocket scientist. But I think the good thing about the field of finance is, to put it bluntly, there is no limit to human greed, and people always come up with new ways to make money, and then that means new techniques and new sciences to go with that. So there's certainly the very mature or adapted sciences in the field of finance. But on the other hand, there are new modeling techniques, etc. Lisa can probably point to many of the exciting areas. In risk, the extreme value theory is certainly getting more and more attention in that, and also along the further development of volatility modeling, etc. I think even just on the point of just getting excited on an intellectual level, I don't think you'll be bored in this field.
Lisa, do you want to talk about cutting edge of finance?
Well, lots of things I could say. I'll just mention one new area, which is an odd marriage of the all-important greed that Sydney brought up, and California do-gooding. Green investing is a theme that's becoming very, very important. There are green funds every day, and people are interested in understanding science of new technologies and what are good businesses and what we can do to stop global warming. All of this is really having a huge impact on the finance industry. And at MSCI Bar, we're very interested in that, both from a perspective of indexing and also from understanding to what extent that's a financial risk factor. And it's nice for once to be doing something that both can make you rich and improve the quality of life all around. So that would just be one interesting thing that comes to mind.
And Matt, you're involved in credit derivatives, structured products, mortgage credit risk, probably the hot areas of the field. Any sense on what the new hot areas are going to be?
Well, my answer is going to be a little bit dated, but what was going on was that over the last few years, there was a sort of, how should we say it, rapidly increasing level of complexity of instruments. So that was a very interesting area in that to accurately model a subprime mortgage deal, I think, would be impossible, quite frankly. I mean, there's some approximations that need to be made, et cetera. And it's very interesting. I think that that's unwinding a bit in that people are shying away from that level of complexity. I think in some sense it was complexity for complexity's sake. Even so, just ratcheting back one or two levels is still a very interesting modeling problem. So if you're interested in mathematical challenges, they certainly exist. I think Lisa's take was very interesting. Applying finance to solve problems in other areas is something that's gaining a little bit of currency. The idea of using financial derivatives for insuring against earthquakes, for example, or figuring out ways to improve home financing through not just debt structures, but debt equity structures. Things like this may not be the same challenge as, modeling a CDO or a CDO of ABS, but are very interesting, are very hot, and are very useful actually to society. So it's one of the aspects of financial engineering that actually makes you feel good.
Great.
That's your question?
Well, I think we are coming to an end here. I think in terms of key takeaways, I thought Linda's comments were pretty valuable. This is clearly going to be a challenging job market. These things go in cycles. I remember 94 and 98 and 2001. There's always markets for people who are viewed as assets for the firm and are able to add value to the firm. So there will always be jobs for good qualified people. I think the most important takeaway is that you've probably heard from each of the panelists is not to enter this field if you're looking to just get paid. The people who are successful, the people who do well, the people who get jobs are the people who are truly interested in the field of finance. At the end of the day, financial markets are made up of people buying and selling and making investment decisions. And unless you're interested in studying people and people's behaviors and how people's behaviors influence asset markets, then this probably isn't the right career for you. We're going to be around for the next half hour, 45 minutes, answer questions. There's a cocktail reception. Feel free to help yourself to drinks and food in the back of the room. I want to thank Matt and Andrew and Lisa and Sydney for your time today, and thank you all very much. And those of you who